Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm joined with my good friend Doug Heagren. Hey, Doug.
Hey Kirk, how you doing? I'm not any richer. I'm actually probably poorer after the weekend, which means that I wasn't able to win the Mega Millions. I was off remote in a Cub Scout retreat. For anybody listening that has Cub Scouts, it was the Arrow of Light camp to try to get through this great season. And as I was out in the woods, I got the news that unfortunately I was not a winner. So I'm here today to be with you, doing my day job.
But in other news, a Florida man. What is it? Why is it always a Florida man that's in the news, Doug? That's what I want to know. It's a Florida man won the Mega Millions jackpot of $1.55 billion. Yes, a Florida man. The one that has all the other crazy stuff happens. They were the one that won this. So kudos to the man. It could have been a woman, actually. I don't know if it's come out who it is, but kudos to the man or woman who won the $1.55 billion lottery in Florida. And the rest of us, I guess we just lit our money on fire for no reason. So congratulations to you all. I did the same, but I did it in the spirit of hope.
Well, here's the question: if we know what a Florida man could do without money, what could they do? What kind of trouble could they get in with not a billion, because we already determined it's only about 300 million, which is not going to get them in near as much trouble as a billion. But what could they do with all of that money, and what craziness could they create?
I don't know, but I wish it was me. That's all I can say, Doug.
But who's the
So
biggest winner in this, Kirk? I think you sent me something on
the
this.
the biggest. So thank you for reminding me, Doug. So the biggest winner in the Mega Millions jackpot was the IRS. So I got to pull up the numbers. So the winner of the jackpot, I think, takes home around 400 million. I think that's the number that they get. Was it? That's correct, right? 400
Yeah, we
million.
were at 300 and some when it was the previous jackpot, so I'm sure it was over
Okay.
four now.
I
Yeah.
think it was 377 in
Yep.
Massachusetts is what you'd bring home, and it went up a little bit. So let's say it was 400 million is what the winner would take home if they took their money up front after tax.
Right.
You know who made more? The IRS. The IRS made $690 million off the winner. 690 million. That doesn't include the states. The states get their cut too. So the biggest winner. So congratulations for the IRS for winning the Mega Millions. All you guys and gals, you're working real hard over there. Congrats. You got a big chunk of change to go fund our our endless debt and deficit. So good work, guys and gals.
I didn't check the fine print, but do you think that when they wrote when they passed the IRS adding 80,000 new employees, that in the fine print it said depending on the Mega Millions jackpot?
I have to say, Doug, that when you think about these things, I don't know if government employees can win this. I'm not sure if that's
No, the
possible.
government took that money back so they can now afford to hire the 80,000 employees. That was the
Yeah,
caveat.
it's crazy. It's crazy to even think about. I mean, the amount of money that is, and what that would do for. I mean, and it's just going to be lit up in smoke. I'm sure it's because this is the way the government does things. Anyway, on to more cheery topics. Yeah, so let's move on. So congrats to that person who won in Florida. Hopefully they don't declare themselves, or their life's gonna get destroyed by all sorts of stuff just because money just that kind of money doesn't help at that level or that quickness, right? If you didn't earn it, it's gonna harm a lot of people. So anyway, let's get let's get into it. So before we get into some other things, I actually want to relay one more story. I got a letter from the AARP last week.
Yes, you did.
I was,
Congratulations. You're
thank you.
50?
No, I'm not even 50. I'm not even 50. Even on my birthday, I won't be 50. So I don't know how they got my name. I don't know if it was a mistake or if they're getting desperate. But nothing against the AARP, but a little young to be getting letters from that. And I'm sorry, you're not getting a check in the mail from me. Oh boy, good. Love life these days.
Didn't they
Everyone's
didn't
got
they
their hand
offer you
out.
a 2-for-1 special, Kirk? I think.
They didn't. They actually said in there, "Oh, your spouse has to apply separately." And I was like,
Oh,
"Oh,
okay.
okay. I'm sure she's going to be a willing participant in this charade." But I feel like everyone's got their hand out now. Like you're like, yeah, I wanna cut my cord. I was actually called up yesterday to cut the cord of my cable company, and they were going to call me back today with somebody who could actually handle it. And of course, nobody called me back. Like, great, just never. They're just going to keep taking my money from me, and it's just it's all good fun. So anyway, into real news. The CPI came out last week, and it was 3.2%, and it was a people said, "Oh, it was better than expectations." Well, still a rise in my book, and I don't know what people are expecting, but it's we're going forward. I do not expect the CPI to have much movement from here unless something really bad happens. I think interest rates are going to stay where they are. I think inflation it could certainly go lower, but real estate seems to be holding pat. As long as real estate's holding, I think CPI is it can go a little lower, but it's not much because you have other things that are actually pulling it up now, like energy prices. So I think right now we're in what Jeremy Grantham called the messy middle. And there were times to make easy money, and according to him, he said the times to make easy money are gone. Now we're in the messy middle. Now it's just going to bounce around like we've been talking about in the show for quite some time, and I think that's where we are. Whether it's inflation, interest rates, markets. The markets had a little bit of a sell-off last week, shocked everybody because everyone thought that the market could just go to the moon forever. So that shocked a lot of people, and yeah, so this week we started off with an up day, but every day is an adventure in August when the traders are in the Hamptons and you have the rookies trading the markets, so anything could happen. But yeah, let's get into some interesting charts here. So, and I'm going to let Doug talk too because we're going to keep this abbreviated in the interest of summer. Let's see here. So we've got. Let's see. Let me share my screen here. Boop, boop, boop. Sorry to bore everybody with my banter. All right, here we go. So here's a chart I thought was interesting, and we got a bunch of charts we're going to put out, but since it's the summer, we're kind of keeping this a little abbreviated. So I thought this was interesting. This is a chart on unicorns. Now you're probably thinking, really? Unicorns? I didn't think they were real. Yeah, they're still not real. But in Silicon Valley, where we live, they pretty much live in fantasy land, just like most people in California. The unicorns are real because a unicorn in California speak is a company that reaches $1 billion. Now, if you look at this is a chart of North America versus the rest of the world, and this is companies that are reaching that status. And you could see a sharp drop off after 2022. Up until that point, money was prevalent. Everybody was making money. ChatGPT, one of the fastest companies to reach, I forget how many subscribers they had, but one of the fastest growing companies ever. It seems like every new technology, the growth just gets exponentially faster. But if you look here, there's a sharp drop off in number of new unicorns. Now, I only bring this up because, we talk about in the show how people really are not in tuned with reality in the economy versus the stock market. So the economy is one thing. The stock market is something completely different. Yes, they are correlated and related, but the stock market is based on nothing. It's based on a bunch of people getting together and deciding on prices. It doesn't always make sense. As the old saying goes, the market can stay. What is the phrase? I'm drawing a blank here. I'm having a tough day here, Doug.
The market can stay irrational longer than you can stay patient.
No, it's the market can stay irrational longer than you can remain solvent. I think we both.
There's two versions, but that one is a much bigger reality.
Yeah. So if you think about it, like everyone just was assuming market goes up forever, let's buy and hold. And then last year, no matter what you held, you pretty much more or less lost money last year. And then this year, the market's back again. Everyone's in bull market mode until Apple came out with their earnings and shocked a lot of people. And basically, they more or less said, yeah, we're going to have a tough 2 quarters, and the stock people took that and the stock dropped a bit. But I only bring that because people think that this is just we live in this magical world where the markets go up forever and nothing bad ever happens, and that's just not true. You've got a lot of big tech companies that are doing well. You've got some that are struggling because look, if you're selling a $1,200 iPhone, at some point people are going to run out of money. Right? In a bad economy, sometimes people say, well, maybe I'll hold my phone longer. Maybe I'll find an Android phone or whatever. and the point is we're getting into this time where we're starting to see effects of the economic growth is going to start to affect the stock market. And you start to see it in stock prices. So we saw some last year. This year we saw a big run up. Everyone's happy again. But the reality is if you really think the stock market is going to go to the moon from here, you might want to check your portfolio, because there's going to be a point where things turn. And we've had a good run. We're close to the all-time highs, but I don't know. If it was me, I wouldn't be getting too greedy here. I'd probably be looking to take some risk off the table and to look at ways to manage risk, because if the stock, just because the stock market's gone up since 2008, pretty much a straight shot, doesn't mean it's going to continue that way. So everyone should just kind of keep that in the back of their mind as they're looking at their portfolios. If you're expecting 15% a year growth in your portfolio, then you probably should talk to an advisor, because that's just not normal. So, Doug, what things you want to talk about here? I'm going to put up some new charts.
The first thing I'm going to say on the last part you said is, unfortunately, there's a lot of advisors out there that would tell you they can get you 15% growth to sell you on, on why to work with them. So, if they're promising those types of returns, it's probably a good time to be like, inching your chair towards the exit. But you made me think of something when we talk about unicorns and billion-dollar companies, and that was, what is a billion-dollar company, right? There was something you sent me a week or two ago. We were kind of going back and forth. Charter did another chart on streaming versus cable, and just the battle that they've had going on. And again, the chart is streaming is winning, and it showed the share of total TV consumption. 38% to streaming, 31% to cable, 21% to broadcast, 11% to other. And then it showed the 10 largest entertainment companies by market cap. 190 billion for Netflix, far and away. Comcast, 180 billion. Disney, 158 billion. Sony, 116, and so on. Now, the first question I have to anybody that just would close their eyes and not really look at these numbers, and I said, what's a bigger company, Comcast or Netflix? But most people would probably say, when I say bigger, and I mean revenues, bigger company, more subscribers, most people would say Comcast. Comcast makes an incredible amount. You're not getting Netflix without Comcast. They are the link for most of the markets in the United States in terms of getting your internet. They also still provide a very lucrative cable service. But the reality of it is that's not number one on this list. Why? Market cap, 190 billion. So when we start to talk about unicorns and we start talking about the investments, the investing and making 15% per year, I think it's really important for people to understand what in the world this means. Like, what is market cap? What's bigger? Just because, and this goes back to the .com, and this goes back to, like you talked about ChatGPT, the fastest to a billion or whatever that number record was. We start to get enamored with these incredible valuations of these companies, and we all, almost everybody that was around then knows of a story or heard a story of a company that was basically had a handful of employees, and then it sells for $5-10 billion. And this is what we call market cap or valuations, but they're artificial. We've got companies out there that make more revenue that per year than and yet have a smaller market cap than the market cap of a bigger company. And what the market cap is, I think it's important for people to understand that education. That market cap is the valuation that is derived based on the stock price and the number of shares that are outstanding. Okay, so if I have a million shares and I have a $10 stock price, I'm a $10 million market cap. Does it really mean that I'm a thriving, healthy company? No, not at all. Doesn't mean anything. Again, I don't know if it was Snapchat or WhatsApp or one of those. I think it had 10 employees and sold for a couple $1 billion. But this goes back to that market that what you're talking about, these returns, is there's all this money being invested in the markets out there in these companies, and they're getting bigger and bigger and bigger because stock price of these companies, or if they're not public yet, this would be the estimated value of what those shares would be, or the value of that company. But it's all opinion. It's all subjective. And I think it's really it's an incredibly misleading number. I told Craig or Kirk, I think it's one of the most misleading numbers ever, because, I think the revenue now, I think when you're investing, there is something to be said about getting caught up in the growth and of the stock price, but there's also something to be said about being able to find true value in the success that a company has and its ability to do its job, its ability to sell, its ability to create revenue. And especially if you're looking for, the ability to have an investment that might have some sort of longer term safety to it. Because obviously, if a company's market cap is billions of dollars with 12 employees and very little revenue, maybe no revenue, and again, it's not the dot-com era, so that doesn't exist as much as it used to, but you're talking about something that could make you a tremendous amount of money, and then all of that money that you've made can evaporate overnight. And again, this could be an argument between growth versus value and fundamental investing versus, technical investing. But, just when you talk about these companies that are worth this type of money, and you're talking about the returns that we're looking at, again, the valuations of these companies can change very, very rapidly based on the value of those stocks. And it doesn't necessarily mean all the time that company is a quality company that actually is producing a lot of revenue. It's just a total side tangent that kind of made me think of something you and I were talking about a couple of weeks ago.
Yeah, let's dip into some of these charts here in the interest of time. I want to hit on some of these because I think they're kind of fascinating. So, I want to hit on this about real estate. This is the existing home inventory versus the number of realtors. So, the number of realtors outpaces the single family home inventory by about 600,000. I think some realtors may be starving in pretty much every state, Doug. I mean, I only point this out just because I thought it was somewhat humorous and funny, but at the same point to show a trend. And what we see here is basically at the peak of the real estate bubble, the amount of homes out there peaked, and then it's just declined significantly in the amount of inventory. And we talk about this in the show, and we go back and forth, and I think for me it's been pretty clear, like affordability makes everything work or not. The amount of inventory, it certainly supports the housing prices, but everyone I've talked to, and we're going to get an expert on, one of our former panelists we're going to have on as a guest in probably the next month to talk about this, because she's in the weeds. She's inside out in the real estate community, knows everybody. And I was talking to her this morning about this, and what she told me, she said, look, she said, yes, you could certainly, just like we said, right, in the show, is that, yeah, there's certainly a shortage of inventory, and that's keeping house prices up. But the problem is anyone who wants to move can't, because what are you going to do? You're going to downsize and buy a smaller house and pay the same payments? Are you going to upgrade? You can't. Well, rather than upgrade for your house to get a better kitchen, just reno your kitchen, because it's going to cost way too much to change houses like we used to. We'd just change houses every 5 years. Oh, I want a better town. I want a better house. And what would be better off is just renovating your existing house, because if you change houses, even if the house is the same price, you're going to pay twice as much. So why bother changing? So most people are just sticking around, and they're not. It's not we need new houses. It's that nobody's selling houses because they can't move. They can't afford it. And so this affordability is causing the low inventory. And look, if we had 0% interest rates on a 30-year, inventory would go through the roof. There'd be tons of inventory, be everywhere. If house prices dropped, I don't know, 50%, let's say, I forget the exact number, let's say it's 50%, you'd probably see a lot of inventory out there just because people just need to get out. And it'll be more affordable. People will be looking to buy. We're in a crazy, crazy market. And I come back to the point I made over and over and over again, which is the 70s were marked by mass confusion. People not understanding like how the inputs relate, because we're in a new paradigm. And it's not that people are confused. This stuff doesn't make sense because we're acclimated to a paradigm that lasted from the early 80s until 2021. That paradigm is over. That paradigm was simply low interest rates. Interest rates are dropping. Everything goes up in price. Borrow money, do whatever you want. Now we're in a different environment. And I'm going to show this chart here for a second. Let me just turn this off. There's another chart here which relates to this, which is All right. Well, anyway, I can't find the darn thing, but we'll get back to that. So anyway, my point is, if you're looking at real estate and you're looking to buy, be patient, right? Don't run in and just say, I'm going to buy and I hope rates go down. Maybe they go down, maybe they stay high for a long time. We're predicting rates are going to stay higher longer than anybody thinks. And the yield curve is starting to show that because the long end of the curve is starting to come up, which means that the market thinks rates are going to stay higher longer. Who knows what the Fed's going to do? Personally, I think the Fed, they have to keep them high. If the market doesn't go into a tailspin, there's no reason for them to drop it. And there was a quote. There was a Burns quote. I'm sorry, it was a Volcker quote. I'm sorry, not Burns. I don't want to make that mistake. Volcker had a quote which was basically that the answer was they could have stopped this earlier if they had kept rates lower. I'm sorry, higher, longer, and not tried to bounce it around so much. So he said if we were more patient, we could have got rid of that last bump up in interest rates that went up in the 20% range. He said if we just kept them lower in the cycle in the bullwhip effect earlier, it would have been fine. But that's not what happened, and we saw the huge bump. So I think they've learned a lot, and this time there's really no reason for them to drop it. They're not communicating that they're going to drop it. If they do, it might be a little bit, but you're really looking at 5%, 5.5%, the range. And I'm pretty sure this is the range we predicted about 2 years ago, Doug, on this show. But that's the expectation. So anyone who thinks that you're going to have rates that are going to go down anytime soon, it's only going to come with a massive recession. And if that happens, anything could happen from there, right? And I think rates would probably go down if we have a massive recession because we'll probably have deflation, all that. I remember where I found that chart. It's in the charts that I'm going to share in the next time on the show. So, if you think about really the environment that we're in, there's a good chance that we're going to have a hard landing. And sorry, I'm trying to flip through these while I'm talking, and I'm not very good at this. But if you look at the old era, okay, here it is. The old era of free money and abundance of growth. Everything made money, everything went up. And now we're in a period of 5% risk-free rate. And the potential is for lower growth because all these companies, instead of getting free money, now they have to pay 5% for it, which means less leverage, less growth, and it slows everything down, and it slows down the growth of the economy. So we haven't started to see this yet. The economy is still going through this reverberation, and I think we probably may see it next year. I'm not going to predict this because everyone's been wrong for the last 12 months, and I'm pretty sure they're going to be wrong for the next 24 years. But if you think about where we are going to recession, at some point we have to at least slide into slower growth. Not in every area. Some areas are great, some areas do terrible, but I think we're going to slow down a little bit because we have to. The question is whether you're going to a massive recession or whether it's just a soft landing. But all the analysts that I've ever talked to in the last 24 months have said hard landing, high confidence, but who knows? That the way they change the government statistics around, who knows what it is.
Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today.
So, Doug, I want to give you a chance to, before we kind of wrap it up here. I want to touch on a few things, but when do you do your thing?
Well, I think you've got some other data that shows, that shows some statistics or talks about this. I mean, I think there's still a tremendous amount of money that's out there that, from COVID that has yet to be reabsorbed. I mean, I've heard charts over the last year that analysts talk about M2 money being completely reabsorbed. It's not. I did just see a Wall Street Journal post that just said the U.S. has seen a record increase in homeless people this year as the COVID-19 pandemic fades. That tells you that we are starting to see a greater number of people who are feeling the effect of what's going on right now. We're talking about, and I just posted a chart. I don't know if you've got access to it, but the purchase mortgage applications index weekly has been absolutely plummeting to, I think it looks like 1995 levels. And this is a drop, just a sheer drop from 2021, and it just continues to fall. As you said, it makes no sense. I think I saw that interest rates had popped up to 8. They're back down to they're back down 7.6 range. You're talking a massive increase in the amount people would have to take on in payments. And then you take a look at, why would you do it? I mean, you've got something at a low interest rate. There's no reason to put that out there. So we do have a low inventory. We've got demand. The demand can't afford the level at which people are going to pay, and they can afford to be patient. The only thing that can trigger a greater increase in inventory is people having to move. And that is going to come potentially from one of two things: either a transition of a generation. That's going to mean deaths, baby boomers and greatest generation passing on, and those homes now becoming available. And that's going to take, a time frame of 15 to 20 years to cycle through. You're also going to see a massive economic recession, which again, that leads to job losses. And as low as interest rates are, yes, we have some of the highest number of fully paid off homes in history. We do still have a number of homes, and a large majority of homes out there at low interest rates that still have a mortgage, and people just they haven't built up enough assets on the side to be able to weather not being able to get past that next payment. So, if that happens, then yeah, you're going to start to see potentially homes come for sale. And talk about, the last thing, just kind of talk about, the precariousness of this. Yes, there's still a lot of money out there. And so at the top end, tremendous assets and resources to be able to weather this and be patient. But at the bottom end, Kirk, you do have a chart that just talks about, again, seasonally, what's going on. Back to school season, increasingly costly time for parents. And you can see here that, household back to college school spending, you can see the spike from under $600 in 2007 to now $1,300 in 2023, of which school spending is $890. Okay. And if you add that into now, as we've talked about in the last couple of weeks, a restart of the maintenance of student debt that's out there, which is depending on, families, is as low as $50, could be $50 a month. It could be several $1,000s a month for other families. And then lastly, you add on one other variable that I think is really important, is that if we take a look at just the effects of inflation, yes, it's back down into the 3s. Wonderful. That doesn't mean we gave back the costs that went up the last couple of years. And according to a recent article, U.S. inflation has added an average of $709 more per month than 2 years ago. Okay. So if you start to add $709 more, plus $1,000 more in college costs, new college costs, plus whatever debt maintenance there is out there, hey, Kirk, the money is getting sucked out of the system. That is an absolute fact. The question is, how long is it going to take to suck all that money out of the system? And until that money is sucked out of the system, then, there is going to be no major catalyst to cause everything to unravel. But as you just said, when it does, when that money is gone, and we could talk about this next time because we're starting to see companies struggle to do debt service. when that money's out of the system, welcome to your hard landing. Don't know when it's going to be. But again, we are here to say, read the tea leaves, put your finger up in the air, and be prepared.
So, Doug, I'm going to stay on for a few extra minutes. I know you got to run to take your kids to sports, but where can people find more about you?
I appreciate it. We actually have a seminar coming up this next week. If you want to know more about it, I am a founder of ProCollege Planners. It is August 14th. I think Texas is back in school, and Minnesota, we go back in school in 2 weeks. So it is that time of season when people are starting college, and the kids are going back, and they are trying to, now it's becoming a reality for families, especially if rising seniors. This is college planning season. A lot you need to know. My partner's going through it right now. It's an incredible amount of work. Make it easy on yourself. Get the information you need, because not having it will cost you. ProCollegePlanners.com. Reach out to us if you want to know about one of our upcoming seminars.
Great, Doug. Thanks for coming on the show. You can skedaddle if you need to. I'm going to go through one or two more things, and we're going to wrap it up here. I did want to show a chart actually to talk about kind of the mindset shift here that I think is important. We didn't do this earlier in the show, but I wanted to do this because I think it's important. So here it is. So there are two charts here that are important to understand because they get thrown around a lot, and I don't think people really truly understand them. So the first is the presidential 4-year cycle. This is a lot of gobbledygook and tea leaves and, Mercury being retrograde that we talk about. Doesn't mean it's wrong. It just means that, people are kind of reading tea leaves to align things. Now, the blue line here basically shows the normal. It takes like 100 years of data and says this is the normal returns for a 4-year presidential cycle. So the first year, you get a little bit of a bump. Year 2, it's usually flat, or in our case, it was down because that was last year. And then the third year is usually a great year, and then the fourth year is a little bit up. That is like 100 years of data. That's kind of like post-election cycle, pre-election cycle, midterm, and it kind of goes through all that. So it's interesting because the data lines up frequently, which is why it shows this, right? And last year, it happened to line up. Now, would it have been any different if it was a different year in the presidential cycle? I have no idea, but you should know it because if you're thinking about like, all right, what are the prospects for direction? And this shows basically the next, basically the next five months or so. It shows that it's a seasonally weak period. Historically, it's sideways, but you get some, you tend to get some down years in there too, which I think given the market valuations right now, you might see a down year for sure after the run up we had. But I think it's just an interesting thing to look at and to just kind of relate to where the possibilities are in the portfolios. I'm also going to show this one other chart, which I thought was interesting in the same vein, which is this is looking at the median monthly flow into equity and mutual funds and ETFs. And this is over a 25-year period or 26. Yeah, 26. That's weird. Okay. Anyway, so the chart was based on data of median money flows. So it basically shows that certain months tend to get a bigger flow of money into mutual funds and ETFs. And the reason I point this out, because this is relevant. So it shows November, January, February, April are big months for big money flows coming in. Now, what that means is if money is flowing into the market, so new money flowing into these funds, what it means is there's a higher probability of the funds going up in value because whatever the fund owns, you're going to be buying more of it, which pushes the price up, which means that the prices should gradually rise. Now, so January, February, April, and November are typically strong months historically, and this is a correlation, not a causation. Causation, there is a little bit because typically more buyers than sellers means the prices go up. Fewer buyers than sellers means the price go down. So there is some relationship there, but you should just know it. There's some months that are better than others. August, as you can see, is the worst month, and I think we've seen that so far. September's a little bit of a bump, and October's kind of a negative month, and then November is typically a good month, followed by December. Nobody's really putting money in the market in December, but nobody's in the market, so we tend to have a Santa Claus rally, and that leads into January. So this whole like sell in May and go away, I think if you look at this, there's a lot of data behind that. You sell in May and you come back in like the end of October, you'd be in good shape. You come back for the November through April season, you'd be fine. And historically, the data lines up to show that that's actually a strong period. So right now we're going into a weaker period in the markets, and I just point that out because it lines up with some thinking. The markets have skyrocketed this year, and they've aligned with those other correlations, and now we're getting to a period where they're probably going to start to let's just say take a breather. I don't know what that means. Maybe that goes sideways, or maybe it goes down. But either way, there's going to be a little bit of a breather going on in the markets for at least the next few months. So if you think things are going to the moon, good luck to you. Maybe you should buy another lottery ticket for the $1.55 billion lottery. You'll have better luck than most. But either way, we're gonna wrap it up here in the interest of time. This is a late live show, and want to get home with the family. And next week we're going to be having a truncated schedule as well. And then we'll be going into Labor Day, and then after that we'll be back to kind of normal schedules.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.